Okay, good afternoon, ladies and gentlemen. Today is April 2nd, 2014. My name is Michael Comeau, and I'm a columnist and editor for Minyanville. Today, I will be joined by Rafael Diamond, who is a partner at Archaea Capital Research. Rafael is an expert in global trading, global macro trading and analysis, and he has quickly become one of Minyanville's most popular contributors. Today, he's graciously volunteered his time to discuss the two hottest topics in markets this week that have nothing to do with high-frequency trading, and those are Friday's March NFP report and the recent huge boom in emerging markets. As you know, this webcast will be recorded and published online, and we will send you a replay, so you don't have to worry about emailing us to get it. So, Rafael, how are you doing today?
Great. Thank you very much for having me on the call, Michael. Thanks, everybody, for joining and taking time out of your busy day to listen in. This is our second call. Some of this was covered in that previous call we did a few weeks ago, but I think a lot of it's still fresh and probably worth redoing briefly as we set the foundation, I think, for what I think is going to be the next 3-6 months of very interesting trends in the market, some of which may only be beginning. So just very briefly, our philosophy, Michael can send out the link to our website, but I founded Archaea with primary philosophy being to adapt to the market. We're not paid to have an opinion. We are trying to react appropriately and avoid big mistakes, hopefully, such as what many of our readers and many people that we exchange notes with were probably trying to short emerging markets only 30 days ago, and yet here we are. So the market that we are in today moves very quickly. We are trying to get to the bottom of what fits, and we write about it when it makes the most sense, and we try to anticipate, giving everybody a lot of time to reflect and make their own opinion and maybe even challenge us and send out contrary ideas. We always like to exchange those thoughts. Let's talk about NFP. NFP is in the headlines. It's being the big catch-all, weather, oh my God, the U.S., and how's it going to be and all that. Well, I'm just going to cover this very briefly, but in this chart here, the NFP actual versus revisions, I believe that's where we are now, MC?
Yes, correct.
Okay. Just very briefly, let's focus on the bottom two lines that look very close, the blue and the light blue and the red. These are basically the NFP releases, actual versus first revision, and the differentials plotted at the top. As you can see, revisions over the last several years since peaking in 2011 have been on a gradual deteriorating trajectory. That suggests to us that the probability and magnitude, we wrote about this, I think, in Minyanville in October of last year, 3 months before NFP became, the number one headline. We just, pondering here at the time that the magnitude and probability of negative revisions, meaning below zero there, as you can see, it's oscillating around that zero line on the right axis, would increase, and the probability and magnitude of positive revisions would just decrease over time. In other words, we are foreshadowing an eventual, and at the time we said maybe 18 months out, maybe 12 to 24 months out. We're foreshadowing, over the next year or so, an eventual end to the hiring cycle. Right? But what really got our attention as we go to the next two slides, in particular the forecast error volatility. We run models on all economic data in the U.S. and other countries, and we not only run the actual data, but we run models versus forecasts. We like to figure out if market participants are on the ball. We like to figure out if they've been correct over time. We like to figure out what the impact or correlation of the surprise is versus price, right? So there are periods of time when the market cares about economics. There are periods of time when the market trades opposite to the economics, et cetera. So we like to adapt, as we mentioned before, to this information in real time. And these trends actually develop and sometimes last for several months and give you many interesting ideas. This was one of them. In October, November of last year, as you can see here, this is the red line again is the NFP, actual release. There's a band around it. Hard to see, but it's a gray band. It's an error band showing the high and low estimates from the submitting economists for the survey. And at the time, as you can see, because one of the reasons was really because the red line hadn't really been moving very much for several months, the error rate, or the distance between the average consensus economist estimate, and the actual, right, release was at near an all-time low. Actually, it was an all-time low, the volatility. So as we said at the time, it's never been easier to be a contributing economist to the NFP survey. We almost signed up ourselves, but at the time it was probably, you know, the trend, as we argued, the trend had probably ended, and it looked to us that error was going to be a very significant problem in the NFP forecasting business soon. We didn't necessarily predict the weather, right, in December, January of this year. We were not talking, we did not think that the economy was going to go into recession or anything like that. We were just saying times are going to get rough for economists, and eventually this could have meaningful implications for, you know, an end to the labor cycle, maybe even an eventual recession. But that's 12 to 24 months down the line, maybe. And the next chart kind of illustrates why I think that is. You could see that, and this is another differential between the NFP and the last revision, which is usually the second revision, in sequence. You can see that the peak revision between the first and the last NFP release was in 2011, similar to 2005, at which point it kind of started curving around and oscillating around zero and making lower highs. And, you know, it's hard to think of economics as a, you know, this is not a very precise statement, right? But you can see that, and this, by the way, this is the original chart from October. If you chart it all the way now to March, which is not in this presentation, but we'll probably do an update after, you know, the next release just to get it out there. This has been oscillating around zero, and it's actually getting worse. So at the time, you know, can we kind of meander around these levels for the next year? Of course, it's possible. We're not in late cycle, we don't think, in the U.S. yet. It can take a little more time. But we don't think, you know, basically the best days are behind us. I think that's probably an obvious conclusion. Everybody knows that, right? This isn't 2009, right? There's a lot of things suggesting out there that we're transitioning maybe from mid-cycle to late cycle. And I think a lot of the themes for the rest of this presentation are going to kind of add to that mix and hopefully support that. Let's talk about Brazil. Next chart, Bovespa Brazil. We run a lot of different models for sectors, global sectors and global indexes, currencies, rates, and commodities. In February, right around mid-Feb, I think we published in Minyanville around Feb 13 or 14. Our last presentation, our last webinar, I think, was the 19th, if I'm not mistaken. The Bovespa was trading at 46.5, 46,500. The Real was trading at 240, 239, 238, what have you. And out of every single emerging market out there that we look at, ranked from best to worst in terms of potential, and we do a very simple assessment of probability of rally, right, or even mean reversion over the next 2, 3, 4, 5, 6 months. Brazil was ranked squarely at the top of the list by far, and I'll show you why. These charts we're going to look at here, they're just visual aids. I'm going to get to the actual calculation in a second. This first chart obviously shows you that what we were experiencing, despite the very small, I mean, comparatively over the last 6, 7 years, the decline from October 2013 to February of 2014, right, this 4-month decline, really wasn't that big in terms of price compared to what we've seen, the damage and destruction that we've seen in the last 5 years. But yet it was registering quite significantly in this model. This is a trend model that we run. Similarly, in the next chart, this is a very long-term trend oscillator that we run for the Bovespa. It has fundamentals, it has quantitative models underneath it, so it's a kind of a composite, but it tracks these very long cycles, right, very well. So what this is telling us is, okay, either this is the end of the world, right, because kind of like 08 is happening again, as you can see, right, in a repeat, or the bar, right, is so low. Look at the blue line that we've added at the bottom. The bar has been lowered so much that you're not going to need much upward price movement here to suggest perhaps that maybe the entire 2, 3, 4-year decline in the country is ended. And we could be in the beginning of a cyclical bull market, maybe even a year, maybe a 2-year rally. in Brazil. God only knows. And we knew that the market was cheap. Everybody knows that. But when, right? Does that matter? This was suggesting that it could matter almost imminently, like the previous chart we looked at. But this next chart, IBOV 3, contains the material, some of the material that we published in MV about a month ago, and shows very distinctly that for only the 9th time, really, in the last, this chart goes back to 97, but this is actually a 20-year model. There's just not much interest. Nothing happened between 94 and 97 on this model, so we just cut it to 97 because it shows 98 very nicely. And 98, right, is on everybody's mind because, that's what we kind of experienced last year, right, with the Fed starting to take out liquidity and, Japan, the yen devaluing very strongly ahead of what was eventually a crisis, balance of payment crisis, as exporting money, got shifted around Asia, et cetera. So there's a lot of parallels. There's a lot of time and effort and economic dialogue spent over the last 12 months comparing and contrasting what we've experienced in the last 12 months in markets globally versus 98 and even 08, right? And everybody's, pretty much in crisis alert every 5 minutes, right? That's the world we live in. So this model, looking back, nearly 20 years, was the 9th time, right? So this is a 1 in almost 2 years probability event. This occurs once every couple of years, maybe if you're lucky, right? Was vastly oversold. By the way, on a price decline that really, if you look at the chart for 20 years, it really wasn't that meaningful. It's a very small price decline that put us squarely in the bottom 2-3% of readings of this model. And so on the next chart, IBOV 4, we produced a rank return, and we produce this for all markets. We have standard deviations of past results of those signals, but we simplified the chart. We didn't put the band around. The band was basically like a 5% error in the short periods, all the way up to like a 10-15% error. But what this chart shows is the average return, right? If you had bought every one of the previous 8 buy signals in the last 20 years in Brazil, and every single one. So first of all, right, the average was around 20% if you held it for 3 months. This is mid-Feb, mind you, okay? With the Real at 239 and the Bovespa at 46.5, we were basically forecasting a 15% to 20% local return in the Brazilian market without dollars included. And if you add the dollars, you probably put in another, half of that on top. We were essentially forecasting a 20 to 30% return on the Brazilian market before the summer. We weren't forecasting that. The model was telling us this, and in the face of, absolutely grim sentiment, which, by the way, persists for Brazil and other emerging markets. It's going to get even more interesting as we get into China in a bit, but this is the 5th chart on Bovespa. Contains the 8 previous instances which we averaged to generate that return line that you just saw in the previous chart. And you can see that not one of them, including 1998, which, by the way, is the very first chart, had a drawdown more than 10%. Actually, the only one that had a drawdown, right, that you would actually worry about was 08, okay, which had a front-loaded drawdown. I believe it was of almost 20%, but ultimately was profitable 10. Not so great, not our kind of trade, okay? But the other 7 instances, including 1998, were profitable from day 1, okay, which was amazing to us. This was really, so let's take an average of 98 and 08, and one of those 2 may be right? We don't know which one, worst case scenario. And we probably have a decent risk reward here if we set a stop somewhere near the lows of last year, for example, unless it's if it's an implosion of the world, maybe it'll break the last year's low, maybe, there's a lot of things you could do at that point to mitigate the risk. And so that's what we advise, at least we did for our account, and for our clients. And the result is, right, Brazil is up. I mean, we had no idea it was going to be this insanity in March, and again today we had even more. But we were talking about this before the call with Michael. I don't feel that we are, this is the end. If you ask any strategist on the sell side out there in Brazil that covers Brazil locally or internationally, if you talk to any large asset manager, they're all over the news. You can read about it. You know, Goldman Sachs Asset Management has pitched in. PIMCO has pitched in. Everybody's given an opinion on this rally in Brazil, and absolutely nobody thinks this has legs, except me.
Okay, Rafael, let me ask you a question then. How would you rate Brazil's actual economy? Because it feels like a lot of these emerging markets, they seem to be rising out of bad news. Is that what's going on in Brazil?
So, the market, I think we could be, okay, and it's too early to tell, but we could be at a situation, I mean, everything points to it, right? We'll get into China in a bit, and I think that's going to add even more, I think, weight to what I'm about to say, which is we are in a situation where the markets are extremely depressed. They've been down for 4 or 5 years in some of these countries. We've been bearish, Brazil, for many years. We've been bearish China for many years. This is the second time we've been bullish other than the summer of last year, even we were briefly bullish. But I think the bullishness that I have here and the signals that we're reading here in Brazil, in emerging markets, in China, in Mexico, and a lot of other places suggests that we're in a 2-3 month kind of a limbo where the markets are going to advance very rapidly, China included. Okay? And by the summer, you're going to see the economic data improving in emerging markets. A lot of the fear in emerging markets, other than the obvious, oh, there's a copper financing meltdown, there's a structured product meltdown in China. There's a lot of crises-related fears out there. I think most of that stuff can probably be addressed, especially in China, for a number of reasons. We'll get into that in a second. I think the biggest fear out there for large allocators of money, okay, asset man, and the guys that will move the market after we're in the trade, right, are that the economies, right, the fear is that once you devalue the currency, which they've pretty much done, or the market has done for them over the last 12 to 24 months, you have two problems, right? You have a pickup in inflation, which is very problematic, and that's ongoing, right? And they've been hawkish. Brazil, for example, has been more hawkish. And there's a lagged period between where the currency depreciates and the exports finally start picking up and contributing positively to the bottom line. They have not yet. So it's a double whammy, right, for those reasons. So I think by the time you get into the summer this year, you're going to see industrial production already well higher than it is now in a lot of these countries. Not in every single emerging market, but in the ones that matter, I think, the ones that are just completely given up on. And you're going to see a lot of these lagging economic indicators like exports start to roll higher, just like the stock market has. By that point, I think the stock market will probably be 15% higher than it is today in Brazil with the currency if you're a foreign investor. I mean, I think Real probably goes another 5%, and the stock exchange. There's a lot of stocks in Brazil still trading right off the lows. They're just starting to get bid, because a lot of stocks are not in the index in Brazil, and investors, when they buy Brazil, they buy the index. It's not just EWZ. There's a lot of really small penny stocks, a lot of residential construction companies that rode the leveraging boom and everything. They've been given up for dead. They're at low single-digit Ps. It's almost like Greece in 2012. So at the margin, if you get a very small improvement, which is what we're already seeing in some indicators, but it's tiny, right? And if you have the central bank acknowledge at some point, and I think that's coming soon, very soon, if you get the central bank to acknowledge that inflation is actually peaking, in other words, allowing the central bank starts shifting to a slightly more dovish posture, which I think is, this transition will probably occur over the next 3 to 4 to 5 months in Brazil. By that point, the market's already sniffed it out, and it's already much higher. That's where I think we're going in Brazil. It's a re-rating towards that. I don't know if you have any more questions on that before we move on to China.
No, why don't we move on to China?
So China's saying pretty much the same thing. This is what really got us interested, because we got bullish Brazil out of a Brazil signal in a vacuum, right? No other emerging market was looking as, quote-unquote, safe let's say, if there's any such thing. But the risk return was so asymmetric in Brazil last month that's really all that interested us. And we didn't really think much of it as, oh my God, this is an EM rally, buy everything. In fact, we just said buy Brazil. And we kind of scratched our head, how can this be? How can this happen in a vacuum? How could Brazil go up 20, 30% in 3 months without China, without, how can this happen with copper imploding? It just didn't make any sense to us. But look, here's what happened, right? Brazil's up and everything else is flat. Well, China's up too, but it's, it's not that impressive. And I think China's about to wake up in a big way. And here are the charts. Well, let's look at the top index is the H-share index, the Hang Seng China Enterprises Index, widely followed. There's several indexes, but this is the one we like to watch the most. Overlaid on it on the top panel is the China Economic Surprise Index, negative 100. Call us bullish, right? So this is just an oscillator, right? Constructed. I don't know if people know, follow the surprise indexes, but these are invented to basically calculate the differential of the actual data releases versus expected. And I mean, are we going to go lower than 08 here? Yeah, it's possible. Okay, but that was a pretty fantastic time to be buying China. In fact, you don't buy emerging markets in 2011, right? Because you expect their growth to be superior to that of the U.S. because their growth was superior to that of the U.S. between 2009 and 2011, right? You buy emerging markets when their growth is expected to be inferior to that of the U.S., and their growth has been inferior to that of the U.S., or at the margin has been much worse than expected over the last 2 years, right? That's when you want to buy. That's when equity values have been depressed, and that's where we are today. The definition of what's happening in this chart is a derating, right? In fact, this is our oscillator, our long-term trend oscillator for China, equivalent to that of the Brazil, by the way, that you saw a few charts ago. Again, just plumbing the depths, right? So, of course, there's a lot of high risk involved in something like this because, for example, in 2011, when you had this very low reading, that was just kind of halfway down, right? That big drop. And then there was another low reading, and that was, so where do you know, right? This is a high-risk situation. This is not a guarantee like, and Brazil wasn't either. It felt like a terrible trade to put on. This feels absolutely terrible trade. This is a horrible idea, right? But the next chart says the same thing, right? This blue line oscillator is the same trend, long-term trend oscillator model that we run for Bovespa, we run for China. This is actually one of the worst, by far, readings in the last 15 years. The next chart, China 3, same thing, except this one's even worse. I think this is one of the top 4 worse. And again, look at that blue line. The bar has been lowered so considerably that you don't need much upside at this point to potentially suggest that you could be in a 6 to 12 to 18-month rally in China, right? Finally, the next chart, which we did not show for Bovespa, but we run this for a lot of different markets. It's just basically a panic. This is a sentiment-based model. This is basically a fear, greed, and if it spikes, it's panic, right? And here we are, right, on a very modest decline for 4 months. I mean, given what's really happened in the last 5 years, and it's just everybody's running for the hills. Now, again, in 2011, it wasn't that great of a signal because the market went down anyway, so you kind of took a huge drawdown and it comes back to flat over a few months later. That's not our kind of trade. But even in 2008, you had, a January signal there that kind of rallied for 6 months before, the ground kind of gave way. It was still, for a trade, it was worth it. And for pretty much all other cases, it was a very interesting bottom. One that held in many cases for, at least 6 months, in some cases all the way up to 2 years, 3 years. So that got us very interested because this is a China-only model. This is not using data in Brazil to determine whether or not we want to get bullish China. But if China wakes up, what's going to cause China to go up 15, 20% over the next 2 to 3 months? Well, any number of things could happen. There's talk of stimulus. There's talk of they've actually announced a kind of a light stimulus last night. But I just think, what if the economic data comes in better than expected, since it's at negative 110 at this point? And sure enough, the PMI, I think a few days ago, came in a little bit better. Not great, but a little better. And so in sequence, if you start getting 1, 2, 3 months of better than expected data, even if it's a little bit, there is no way, I think it's extremely unlikely that the Chinese market will fall. So the odds, you know, like anything else, there's no certainty, but the odds, I think, are heavily stacked in our favor. And our stop is there in case we're wrong. So, you know, we like to trade. It's very asymmetric. It's as asymmetric today as it was, as Brazil was 30 days ago. And now that these two signals are active, and, you know, I'm not going to spend any time going into charts over this call, but we're bullish copper. You know, we have a stop there too, but we're bullish copper on its own merits. We're bullish several emerging market currencies, not so much their individual equity markets, but you know, there's some actual currencies that we like. We're even bullish Canadian dollar. We remain bullish Australian dollar. So a lot of these things, if you're tying them all together, I think we're in a situation, potentially, we could be in a situation where if we look back maybe 12 months from now, we were actually reflecting, I was talking with some clients earlier today, and this is a theme I think I'm going to start writing about soon. We may look back 12 months from now and say, the U.S. was priced for 4% growth and delivered 3.5%, and markets were flat. And emerging markets were priced in for, you know, 2% growth and delivered 4%, and they were up 30%. That could be where we are in 12 months. In other words, all of the gains, right? All of the juice has been squeezed out of the orange in the U.S. in 2013 because of the massive outperformance in the U.S. And 2014 kind of pays the piper where the rest of the world kind of catches up. The other thing that I think is very interesting, some pretty respected economists, and again, the very small minority, are starting to talk about a tight labor market in the U.S. Not, you know, a widespread tight labor market, but short-term unemployment in the U.S. is now below 3.5%. That's unemployed less than 6 months. Short-term unemployment supposedly sets wages much more robustly than the long-term unemployed because they have no bargaining power whatsoever. It's the short-term, more highly skilled, right? And we have a skills mismatch in the long-term unemployed anyway. There's a lot of sectors that are at or below at or above full employment. Okay, so there's a lot of, and clearly the Fed wants to be, right, late. The Fed is actually nowhere near saying these things. They continue to say that there's slack in wages. So the Fed is telling you they're going to be late again on the inflation or any pickup in the inflation in the U.S. That sounds like blasphemy, right, that there could be inflation in the U.S. But if wage pressures start moving up in the system, and it looks like they might over the next 6 to 9 to 12 months, then wage as a percentage of the wages as a percentage of corporate profits are going to increase, right? And corporate profits as a percentage of the economy will decrease, which will be a headwind for margins. So that finally, right, that this whole talk about margins mean reverting may actually begin to mean revert over the next year, and may mean revert over the next 2, 3, 4 years, right? And this is actually a headwind for U.S. equities. Whereas, right, if we look back 3, 4, 5 years from now, guess who, all of a sudden, right, if the U.S. is now under wage pressure, guess who, since their currencies have basically been bombed out 15, 20%, right, and their inflation is now contained, guess which countries are going to pick up productivity and start earning, you know, let's go back to emerging markets, right? Let's go back to invest in emerging markets. They are still highly skilled, you know, there are highly skilled workforces there. We already have investments there. So why don't we have a CapEx, you know, the famous CapEx boom people are talking about in the U.S.? Why doesn't that money go to emerging markets all of a sudden in the next year or two? So all this stuff, you know, these are things that we just think out loud, but these are moving parts that are very important, and I think nobody's talking about any of this stuff, and it's possible that if we're transitioning to a late cycle globally, right, and you have all of these factors moving into play, then it's also possible that emerging markets will strongly outperform core developed markets, especially U.S. and Europe, over the next maybe 12, 18, 24 months, as long as they just get their act together, China included. But it's not a tall order, right, for them to get their act together. I think it's been so heavily discounted that they can do anything, that if the surprise at the margin just gets a little bit better than expected, then this is your trade, basically the opposite of everything that worked in 2013 may end up being what works in 2014. I'll leave it at that. Maybe we could talk about a little S&P. There's a couple of charts there if we want to talk about it, but that's pretty much it.
Yeah. Well, I think before we go into that, now I'll disagree with you slightly because just because emerging markets have done so well over the past week, there are starting to see headlines. But we also saw. Do you think there's any relevance to? We saw huge outflows in emerging markets ETFs. I believe 21 straight weeks. Now, do you think that's, and Bank of America also just put out a report showing that money managers are very, very underinvested in emerging markets. Now, do you think there's potential for a melt-up, maybe this being the next big momentum trade?
I think it's squarely, given the signals that are occurring in several currencies, including Australian dollar and Canadian dollar, not just emerging market currencies, and several emerging market indexes, and you see the relative underperformance developing in the U.S., and you see commodities holding, quite well, with the exception of oil, but the metals are doing very, very well. Gold probably has building a little bit of downside maybe, but I think gold eventually will be probably a stellar outperformance. Everything is building towards, I think, a coordinated melt-up in the entire space. Yes. The things that kind of work. When was the last time that this commodity / EM / reflation, but based on good news, not just quantitative easing too, or when was the last time this really happened? I think it was in 06, 07. At the time, as we transitioned into late cycle in the U.S. and inflation started picking up, and wage pressure started going through the system, and people got levered up and all that. So maybe that's a repeat of that. And it happened in it happened in 97. It happened so maybe that could be it.
Okay, so so when you talk about entering markets like China and Brazil, now how are you doing your actual buying? Now, are you simply using ETFs or are you buying individual stocks? What do you actually use?
Well, it's a combination. With Brazil, we traded a lot of local stocks. We want to be long the currency, so we have forwards in place. But we are long the stocks locally. We have a basket that we built to just hold. We didn't, a proxy probably for a U.S. investor would be EWZ, but that's weighted by market cap, and it's not it's not 100% correlated with Bovespa, but it's close enough for most. But we just felt like that was not going to earn. I mean, yes, it was going to be a good return, and it has been, and it probably has more upside eventually. But in a move like this, you really want to be more towards an equal weighted, and so we kind of overweighted some of the sectors that we thought were going to be more bigger gainers. For example, the value, the very, very low value, undervalued sectors like the construction, engineering, and I think that's going to be the same theme in China. And lo and behold, that's actually happening in the U.S. Even in the U.S., you're seeing value outperforming momentum, or the biotechs kind of falling out of bed with some of the more like the utilities making new highs, et cetera. So that to me says something that perhaps this value versus momentum trade may actually have legs not only in emerging markets, but in the U.S. as well, maybe even in Europe.
Okay, what do you think about Russia? Because Russia had been performing very poorly for a long time, and it bottomed basically when Putin went into Ukraine, and Obama's spokesman said to sell Russian stocks, and Russian stocks have been on a tear. Now, do you think Russia also participates?
Well, I mean, Russia's the problem because there's so much, we're not invested. We went in there for a trade right off of the vote. We got in that Monday after it had already bottomed on the Thursday before. The market was already up 10 at that point, and it rallied another several percent. So then we were out. But I think what we like more about Russia's a big question mark because we don't know how the companies will. The government could do anything to these companies. Some of these companies could, be forced into bankruptcy. You never know how far this war is going to go. This financial war is going to go between the U.S. and Russia, and it could get pretty nasty, and it could have implications really for the whole system. But our exposure to Russia here at this point is really that we're bullish the currency. I think the ruble probably bottomed around that 37 level, and we'd be surprised if it went lower. I mean, yeah, we have stops there too, but we'd be surprised if it did not rally, to its own 10–15% over the next few months. That'll probably be bullish equities too. But in Russia, we're not so familiar and so close to Russia, and our models really were not as oversold, even though it was a very, very steep decline, very short-term decline. It didn't really register in our models, believe it or not, because some of our stuff is so long-term that it didn't move the needle per se. So it wasn't as oversold as Bovespa that that had been just trending and trending for four months or so before it really hit the rankings. But yeah, I mean, I think it'll, if China gets a bid and they do the right thing, it's pretty clear that people are probably as underinvested in Russia as they are in every other country, if not more, right? Because remember, some very large asset managers, on top of the fact that emerging markets, there's two things. There's one thing that emerging market doesn't have going for it, and that's nobody wants to show their investors that they have it in their books, right? But Russia has that, and one more thing, which is, and I think, what was it, PIMCO or some large asset manager said, we're not investing in Russia because of their, humanity, violations of
human rights, probably.
Human rights. So they even have like the moral thing too. I mean, so that would suggest to me that if there's a bid in EM at some point, people have to rebalance and fall, get to some level. I think the Russia-type managers are probably going to have to chase the mandates that are for Russia. Probably have to chase it aggressively. It's been very easy to be an emerging market manager, guys, for the last 2–3 years. Believe it or not. Yes, they've been losing a lot of assets, but a lot of guys have been outperforming simply by just being underinvested in the index. It's almost become like this opposite of the U.S., right? U.S. is like this buy the dip mentality, right? That's been working for 3–4 years. EM has been this, God, if I just have like more cash, and just be invested 80%, I'll outperform. That's what a lot of very smart money has done in the last 2–3 years. And now, in the last 30 days, they're up, I think, 2% for the year, and some of these things are up 6–7. So, now it's going to start hurting, and I think in Russia it could probably hurt even more. But again, I think there's just so many fish out there to pick from if you have expertise in a certain country, and if you do in Russia, by all means, look into some of these valuations, because I think the value strategy is real. I think there's a signal out there, and it's, again, not only in EM but in the U.S. there is a value component here that's outperforming. By the way, value tends to do so right at the end of bull markets. So maybe this says something about where we are in the cycle in the U.S. Maybe we're a year away, maybe we're 6 months away, but who knows?
Okay, let's move on to the final question. And so why are you bullish on gold? Because gold is always a controversial topic. So why don't you recap your case for gold?
Well, just very briefly, and I think we said this last time in the call, we got bullish gold in January of this year, around the 7th or 8th, I think it was the 9th of January. We bought the miners, we bought gold, we bought silver, and our call then, and it's still the same call, is that there is a chance, there's a reasonable chance for the first time since the peak in 2011, that the entire correction is finished. Just because a lot of our long-term models, some of the, think about some of the charts I've shown on China and Brazil, those are actually, their equivalent versions for gold have basically broken out, not only for gold, but the miners. And they broke out within 2 weeks of each other together, and they both rallied pretty significantly for about 2 months. And now we've had a nice correction, very big, healthy correction. We've washed out a lot of people. It's been quite, hurtful. We lost money from the highs, of course, but we're holding since January. The theory being that the December lows are probably very well protected in the metal, as well as the miners. And for our time frame, which is, for the next 12, 18 months on this trade and our position sizing, this remains probably one of the top trades on our list, just because on the outside, on the, let's say the 40% chance, 50% chance that the bear market has been concluded, I would say a conservative target for gold would probably be 1,600 an ounce, maybe even higher. And if the miners re-rate, again, the miners here are a value play. They're a value stock. They got down to absurd valuations in the fourth quarter of last year, and we don't want to measure words here. You look at any valuation metrics for the miners at the end of last year, they were just absolutely destroyed. A derating would not do it justice. And just a small re-rating of the miners from here, our call remains that it will probably be a 100% return from the bottom. So theoretically, a GDX or any one of those indexes, around maybe $50 a share, and with some of the smaller, the juniors probably doing even better. But we're okay with, if we're right and it's a 50% trade, we're okay with just playing the miners. We don't have that much expertise in the juniors, and there's a lot of them that maybe won't even make it.
Okay, Rafael, we just got a request to show the S&P charts. So if you could just take 30 seconds to quickly run through those, we'd appreciate it.
Yeah, sure. So let's go to the first chart. It's two charts. The first chart shows what we sent out to clients on a few days after the bottom in February. We saw the bottom in real time. As you can see, there's a double buy signal in the model. Both in the the longer model, the blue one, and just the very short-term spike. The gray spike, the down spikes in the model when they occur are extremely robust, especially in the last 4 years. I think it was like a 95% hit ratio within the same day. Sometimes it took 2 days. So. But the important thing about this chart is that, as you can see, the market had already rallied off the lows into, I think this was mid-Feb at the time, and our model was nowhere near overbought. Remember, the market just took off like a storm. I think the S&P at this point was like 1840 or something, and everybody was like, oh my God, do you want to sell this rally, right? Everybody was bearish, and we said no. We were steadfastly bullish. We said, okay, new highs, very likely. Not a guaranteed 10, 15% returns, but look, this is a matter of time. If you're going to short this market here in mid-Feb, you're going to get killed for 1, 2, maybe 3 months. You're going to probably eat 3, 4% loss, but you're going to waste your time. This is nowhere near a top. As you can see, that was crystal clear in this chart, right? And lo and behold, this is the next one. This is where we are today. So I'm going to just run a very brief interpretation. Look, we've made new highs. We're meandering around there, okay? I could see two things happening, okay? I could see a very short-term sell-off that spikes you back and creates another higher low, right? In which case you buy, and we're going to 1950, maybe even 2000 in the S&P. And we're going to try to catch that in real time and send that out to the MD subscribers. Or we kind of drift higher over the next 2, 3 months as emerging market catches a bid and people start reallocating out of Europe and U.S., going into those places, but the U.S. market still does a little better because the economic data comes out better, the post-winter, and people start there's a marginal upside. Maybe we got 1870, 90, 1900, and we put in a top. We spike a top and we start rolling high. But that process, as you can see, right? We're just completely neutral here. It's as on the light blue line. This is as neutral of a stance in the S&P as one could get. In fact, I would argue that we're short-term oversold, and we're going to have to start rolling higher, sooner rather than later. So hopefully, within the next 2 to 3 months, we're going to get a signal either way, and we're going to position accordingly in U.S., and it'll give us the next big trend move, right? Either way, but we want to be flexible and we want to adapt. Either way, I don't think S&P, NASDAQ, and Dow, again, are where the game's going to be at over the next 2 or 3 months if we're going higher. I really don't think so. I think the game is going to be in emerging markets. It's going to be in some related commodities. And finally, probably very much so in gold once we bottom.
Okay, Rafael, thank you very much for that explanation. Ladies and gentlemen, we will forward you a copy of the presentation and a link to the replay. So you don't have to email us. You can contact us if you have any questions about the market. You can contact us in the email, or if you want to contact Rafael directly, info@archaeacap.com. And Rafael, thank you again for your time.
Thank you all. Pleasure to be here, and talk to you soon.